Good afternoon, ladies and gentlemen. Happy Wednesday, October 3rd, 2018 to you all. I do say good afternoon to those of you who are here, of course, with me on the East Coast. It is just after 12 noon Eastern Time. For those of you in the Central Time Zones, the Mountain Time Zones, and Pacific Time Zones, we'll say good morning to you. And of course, if any of you are joining us across the pond from parts of UK or parts of Europe, or even parts of Asia, we'll say good evening or good morning, depending on where you are. Welcome to today's presentation. We're going to take a look at the power of the Power Options Search Tool to help you find the best trades in your preferred strategy. Now, of course, there are numerous ways to use options to profit, to protect, hedge, or use leverage, of course, in the market. Having the right strategy is important, whether you're selling or whether you're buying, but having the right trade in a strategy is also essential. You can pick the right stock in the right direction and the right strategy for that stock, but still, of course, put yourself in a position where you can't profit that much, or you can actually lose money because the structure was incorrect. There's no such thing, to me personally, as a wrong strategy. Okay? But there are wrong trades and wrong structures in a particular strategy. Would you sell an in-the-money bear call credit or bull put credit spread on a stock moving in the opposite direction? No, I would likely not even sell an in-the-money credit spread regardless of the direction of the stock. I might use an out-of-the-money debit spread in that situation. Would you enter a covered call on a stock with increasing negative news coming out? Think of what happened to Papa John's months ago. Was that a good time to enter a covered call, cash secured naked put? Not really. Maybe a longer term long call at the bottom if you were lucky enough to pick it. Or would you consider buying a 5-day out of the money call to strike 40% above the current stock price, maybe 20% above the 52-week high? Well, that doesn't sound like you're going to make profit. You're going to need a very wild swing, some events to push that anywhere near the chance for profitability. This is not to say that credit spreads, covered calls, or buying puts are bad strategies, but it's a wrong structure for the right strategy. Of course, we know that almost as bad. I see these emails all the time. I get them because I'm in the loop and I like to see what some might consider our competitors are doing, but almost as bad are weekly trade selection services that offer you maybe 5 trades per week. But you don't know how they're being selected. You don't know what research and analysis is going in those positions. It's almost going in blind. Of course, I also see emails and news articles posted on different financial websites of the next rare double buy recommendation or a hot stock for October. See them in emails and teaser claims as well when you're doing Google searches or anything along those lines. Now, sure, I know you're smart. I know you're a good investor. You're going to do due diligence. You're going to research those positions a little bit. You're going to take some look at an option chain to make sure the call or the put or the strikes that they're selecting match your risk tolerance. But again, do you really know what you're getting into with those types of services? Okay. Now, right now, I'm only going to have 2 polls today, but I just want to get some background for those of you that are joining us in live attendance here. Speaking of strategies, speaking of there's no such thing as a bad strategy, I'm just curious, what strategies are you currently trading with options or even paper trading right now? Are you focused your portfolio on covered calls and naked puts? Are you using protected positions, maybe married puts, standard collars, or some combination of selling a call and buying a put against the stock? Are you looking at the vertical spreads, credit spreads, debit spreads, includes iron condors and butterflies? Are you considering buying options? Are you buying calls, buying puts, maybe doing straddles or strangles around earnings? Or are you doing calendar spreads, horizontals, diagonals, other positions like that? So just let me know. I'm going to leave this poll open for about a minute. It's not going to change the direction of our conversation today. I'm just kind of curious what our audience is doing today, what you're doing in your portfolio, what's been working for you over the last 8, 10, 12 months or so. Well, so far I'm kind of surprised to tell you the truth. I have over 50% of our audience voting. A few more votes have come in now. All right, so I've had the poll open for about just over a minute now. Some more votes are coming in, but I'm going to go ahead. There we go. Okay, there's something. Here we go. Okay, good, good. Still kind of surprised. More votes are still coming in. All right, minute and a half. Let's go ahead and close this poll, ladies and gentlemen. I'm going to share the results with everyone, okay? All right, so sorry if you didn't get to vote, but let's go ahead and close that. 44% of you are doing credit spreads and debit spreads. Well, that's good. I'm going to take a look at that. I got 25 of you doing covered calls and naked puts. 19% are doing the protective strategies. My surprise is that only 6% are buying calls and buying puts or doing straddles in this market. I mean, it's been long in the tooth a little bit. We've seen some surprises. I know the big hot stocks have been the marijuana type stocks over the last couple of months. A lot of volatility impeded me from buying options actually on Tilray and things of that nature, but that's okay. And only 6% of you are doing calendar spreads. That's perfectly fine. So that gives me a good gauge of what we're doing. All right, so let's go ahead and hide the poll and get back. Now, how is the Power Options Search Tool different? How does it benefit you? Well, you control the criteria and the settings to identify your trade. In the search in any strategy, you input the options criteria to match your needs and your trading plan, and of course your risk-reward tolerance. But at the same time, you can enter stock technical and fundamental criteria in a given strategy so you know exactly why the results came up on your screen. You know exactly what type of stocks are matched with the correct options you're looking for, so all the trades you see in your results are specifically catered and specifically matched to your trading plan and your trading goals. What exactly is the search tool? What is a patented screener designed for self-directed options investors? We support over 23 of the most commonly used option strategies, everything from credit spreads, covered calls, buying calls, straddles, strangles, and more. You search all at once for the options requirements you have, applied volatility, liquidity, Greeks, and more, and at the same time searching for the stock, ETF, or index criteria you want. Of course, you can screen in our database for weekly options, monthly options, standard expirations, or end-of-the-month options for those new securities that offer those, quarterlies, leaps, everything that's out there. All right, so what strategies are supported in our patented search tool? Well, as I mentioned, speculative if you're looking to screen for calls to buy, puts to buy, married put positions, protective speculative, kind of bullish, and even married calls, shorting the stock and buying a call against it. The buy rights, of course, covered calls. The reverse, covered puts. Selling naked calls, which I never recommend, but I know some of my subscribers use that. Cash secured, regular naked puts. Standard collar or hybrid collar positions. Of course, the reverse, the short collar. Covered combinations, sort of doing a covered call and selling a naked put against it. Vertical spreads, bear call credit, bull put credit. The parity trades, bull call debit and bear put debit. Calendar calls and calendar puts, both horizontal, same strike, different expiration dates, and of course diagonals, where I might be buying a call deeper in the money and selling a near-term call against it, what some might refer to as the poor man's covered call. Straddles, buying straddles or buying strangles around earnings. Short straddles and short strangles for those of you that are generating premium and trying to swing the outside wings. Of course, iron condors and iron butterflies as well. Those are the strategies we support on Power Options. What stock criteria are available for you? Here's a screenshot of our technical criteria. You can filter in any of those 23 strategies for beta. Percent of 52-week range. You want to look for stocks near their 52-week high or near their 52-week low, regardless of what strategy you're using. Stock volumes, average stock volumes, and percentage stock volume. Historical volatility, the stock volatility itself. Broker recommendation, relative strength index, the RSI, screening for greater than and less than to match your ranges of what you look for. If the RSI is near a bottom and you think it's going to bounce up, look for an RSI of less than 20. Or if it's at the top and I expect it to pull back, well, common thought is I might use an RSI of greater than 80. Full Bollinger Band screens to look for stocks that are near the upper range of the upper band or the lower band. Screen for Bollinger Band breakouts to the top or the bottom, or of course the bandwidth. Now, what is the bandwidth there for the Bollinger Bands? If you're not familiar with it, of course, on the search you can always hover over that link and see a definition. More volatile stocks have a wider bandwidth, and less volatile have sort of a condensing bandwidth that's really close. I might use a limited bandwidth range for things such as iron butterflies, iron condors, or maybe a short strangle. You can screen by simple moving average. Just look for positions where the stock's trading above or below a 50-day, 20-day, where the 50-day is above the 100-day, or below, for example, depending on the strategy. Historical trend, how many days has the stock been up or down if you're looking for a more pronounced trend? Or some thoughts here is that some of the broad-based indexes, SPX, NDX, things of that nature, you might consider that, well, usually they only go up about 3 or 4 days in a row depending, and then there's a little bit of a alleviation. So I might look for indexes that have been up 3 days in a row to maybe try to catch a bear call credit spread, maybe a long put, or another bearish strategy. And you can also look at the trends for how many days has the stock been above or below the 20-day, the 50-day, to see a more pronounced trend, and of course use the MACD cross to look for maybe positions that have recently shown a positive MACD crossover in the past 2 days or past 3 days, or shown a negative one. You can also look for where the MACD is above or below the divergence line. For all 23 strategies, you'll see the same stock technicals that you can put in to help you identify bullish or bearish. Now continued, the second section in the search would be the fundamentals for the stock itself. Well, you could limit it by stock price. If you're doing covered calls, collars, or married puts based on your account size. If you only want to look for stocks that are up or up big, you could put in the stock change today or the percentage stock change today. Looking for stocks with positive earnings per share growth or negative earnings per share growth. PE ratios, dividend stocks. If I only want to search for covered calls that offer at least a 3 or 4% dividend yield, selling calls 6 months out in time out of the money, it's easy enough to set up in the search. It's about 6 or 7 clicks and you've got your results. Market cap, net tangible assets to market cap, price to book, price to sales, and then the Z-scores. An older criteria, but it's kind of bankruptcy indicators, the Z, Z prime, and the Springate. Now don't worry about the search by symbol right now. That's if you run a search, let's say you've got 40 results, and then you say, you know what, I wonder if Apple's in here somewhere. We can go to the fundamentals, just put in Apple, and see if it's in your results anywhere. Or if you run a search, you have 50 results for bear call credit spreads, but for whatever reason you notice that Tesla is 8 or 9 of those and you're not interested in doing that right now. It's too volatile for you. So you could come into the fundamentals, remove Tesla there, run your search again, and you'd see the bear calls with all the Teslas removed. For these income strategies we're talking about, 44% of our audience, of course, doing vertical spreads, credit and debit spreads. A very important feature is to, of course, avoid earnings. So you don't get that sudden surprise where you've got everything you've looked at as bearish and you entered a bear call, earnings come out and they surprise and the stock jumps 10%. So when I'm looking for credit spreads, possibly even covered calls, cash secured naked puts, I'm going to avoid earnings between now and expiration. But if you're doing straddles, buying strangles, you might specifically want earnings between now and expiration, or set earnings between now and only 7 days, 8 days from now, so the near term. And as I mentioned, of course, the dividend date as well. All right, now, the other feature we have for technicals and fundamentals, in addition to that, is the lists. You could ignore the stock settings altogether. I don't recommend doing that. But if you have just a list of stocks that you track, you know 20, 30, or 40 stocks that you like to trade calls against, you like to follow to go up or down, bullish or bearish as they trend, you can use our stock list to screen just against a particular company list. You can screen just against indexes and ETFs. You can create your own personal list and scan in any strategy just against your stocks to find the best options trades against the stocks that you want. All right, now it's all fairly simple and all fairly straightforward. It seems like a lot of information. This isn't the best screenshot. I had to cram a lot in here, but let's talk about in any strategy now what you can basically look at for the options. Naturally, we can set the options expiration time frame. If I want to look just 1 month out in time to the next standard expiration, I could select October or I could select November. If I just want to look for weeklies, we can select all expirations and then just look for, say, 0 to 7 days, 0 to 5 days out in time to find just those options that expire this week. And if I want a range, we're going to take a look at that in just a moment. I can select all expirations and put in a range of 7 to 25 days, 20 to 40 days, and I'll see all expirations, all positions that match my other criteria in those specific time frames, whether it's weekly or standard. Implied volatility, whether you want to look for high or low implied volatility, the IV to HV ratio, which is used by investors to sort of gauge overvalued or undervalued options based on the implied volatility of the option compared to the volatility of the stock. A very important one for me for selling premium or buying options is the percent implied volatility range. Where is the option's implied volatility now compared to where it has been over the life of the option? So when I'm buying, I typically want to look for a percent implied volatility range in the lower 40 percentile. And when I'm selling, I might want it near the high 80% or greater. Many of the strategies our audience is using, credit spreads, debit spreads, covered calls, naked puts, you're going to focus on the return. Okay? This is a covered call screen, so I can specifically screen for percent if assigned, the percent if unchanged, what premium do I want, or time value as well. Of course, the downside protection for a covered call or percent to break even in a naked put. How far can the stock drop before I'm technically losing money on the position based on the premium I'm selling? For credit spreads, you'd see things such as percent return and percent to break even, percent return based on the margin requirement and the difference in strike prices and more. In the money and out of the money range, we can set it by number of strikes or percentage. Many of you doing the credit spreads, you probably want to be at least maybe 4 or 5% out of the money. If you're doing 20 to 30 day out spreads, or maybe at least 2 or 3% out of the money for a weekly. You can also set that with delta, naturally, if you want to look for in the money or out of the money, or the probability above or below for a credit spread, probability assigned for a covered call or a naked put position. For a covered call, the higher the probability percent assigned, the deeper in the money you're going to be. For a bull put credit spread, the higher the percent probability above, theoretical probability of stock would be above both strike prices, naturally the further out of the money you'd be. But you can do either or based on your preference, based on your goals and your trading plan. Then of course for the strike price, you can set the bid price or the net credit for credit spreads, limit the ask price when you're buying options, so you don't see options that are more than $10 or more than $15 depending on your requirements. If I already have a positive return for a credit spread or a covered call and good downside protection, why is the net premium or the option bid price important? Well, because you know how on average, how many shares of stock and contracts you're trading for a covered call, how many contracts on average you're trading for your credit spreads. So if you're doing a weekly credit spread, you're doing 5 contracts, something comes up that matches your return, but is only a 2-cent premium on a $1 stock. I'm sorry, a $1 strike difference, my apologies. That's not going to do it for you. You're trading 5 contracts, that's only $10. You're losing half of that to commissions. So I'd want to put in that, hey, I want to see the spreads that have a minimum 15 cents or 20-cent net credits for a 5-day trade, 30 cents or 40 cents for a 14 to 20-day trade. Or selling a covered call, even if I'm out of the money, I may want a minimum 50-cent or 60-cent option premium as well as matching my other criteria. Times, buying or selling, we want to limit the bid-ask spread. I don't want to particularly buy an option that has a $2 bid and a $6 ask. Now, I may get in at midpoint, But if I try to get out of that position because it's not going the right way, I'm fighting the market maker and I might get killed with this wide bid-ask spread. So you can limit the bid-ask spread monetarily or percentage-wise. We usually suggest using the percentage. We already talked about probability, but you can also screen by the Black-Scholes ratio, another way to identify positions that are considered overvalued or undervalued, in addition to, as I mentioned, delta and more. And of course, important, liquidity. Option volume. If you know on average that you trade 10 contracts of a spread or buy 500 shares on average and sell 5 calls for a covered call position, I might want to see an option volume today that's at least 5 times the number of contracts I trade, or maybe an open interest of at least 10 times. I want good liquidity on the positions so I'm not seeing things that haven't traded, right, that have no open interest or low open interest. I want some good liquidity in addition to the other criteria as well. So upwards of about 20 to 25 different technicals, about 20 to 25 fundamentals, and about 30 to 40 different option criteria for every strategy at your fingertips for you to use. Too much? Well, let's take a break. And the key is to remember to keep it simple. In each strategy, we offer a wide array of criteria that we just reviewed to best suit most investors. Don't get bogged down in the details. Ask first what is most important to you. And I'm going to ask that right now. What do you feel is the most important criteria for an options trade? Is it the underlying fundamentals or technicals for the stock, index, or ETF? Is it the implied volatility, Greeks? The probability above or below, which, as we just discussed, also equates to in the money and out of the money? Is it the option with the highest premium? Or is it controlling the risk and controlling the risk-reward ratio? What is most important to you? Henry asked a question. While you guys are answering the poll, I'm going to go back one here. Henry said, is this a playback? No, we are live, Henry. I show no delta under price and strike price. Okay, so while the poll is raw, I'm going to leave the poll open a little bit longer, Henry, and then we'll get right back to you. Again, I only want to leave the poll open for about a minute or so. All right, we've got more than 50% of our audience voting. All right, I'm going to leave it open for another 10 seconds or so. Okay, let's go ahead and close that poll, ladies and gentlemen. Let me share the results with you real quick. All right, so 31% of you are mostly focused on the underlying technicals and fundamentals. The highest one, of course, is 38% of you are focused on the at-risk or the risk-reward ratio. 15% of you are into the probability. Consider that important. That also does go into a discussion of the at-risk. If I want the higher probability above or below for a credit spread, that means I'm technically taking lower risk, lower chance the stock could move against me. 8% of you are focused on implied volatility in the Greeks, and 8% of you mainly focus on the highest premium or the highest return. That's fantastic. Okay, so let's go ahead and hide that. Let me make sure the screen comes back up. There we go. I'm not sure if it's being blocked, but for covered calls, here's your delta right over here. Okay, Henry, the delta is right there underneath the percent to double in the price and strike price field. Now, there's the window for the GoToWebinar screen. I don't know if that's hiding it, but that's where the delta is. It's right over there, and you'll see that in most of the strategies. Of course, important to me, for calendar spreads and diagonal spreads, we also show the delta ratio. So the delta between my two options, which is very important. All right, so we've talked about what's important to you. Now let's talk about trading plan very quickly. Why are you interested in a strategy? Well, you're interested in to make money, either to use leverage or to generate consistent returns against stocks that you own or stocks that you're holding, to try to outperform the market of just buying and holding the stocks. That's why you're an options trader. That's why you're savvy. And of course, you want to be able to control the risk to avoid the unknown. A very common strategy, probably our third or fourth most popular strategy every time we run a polar question. We saw today that second place was investors doing covered calls and naked puts. So common strategy is naked put positions. Goal, monthly range, 20 to 40 days out in time, looking for at least a 3% yield. So on a naked put, that'd be 3% return against the cash secured amount I have to put up, and maybe an 8% protection, 8% out of the money, or an 8% to break even, meaning the stock would have to fall 8% before we're technically losing money on the position. And let's say I want to do this with ETFs that have high volatility. Well, most standard ETFs, SPY, QQQ, going 20 to 4 days out, you might only see a 1 or 1.5% yield going out of the money, maybe even less. So there are other ETFs out there that are a little bit more volatile, but are also bullish, that'll offer a higher percentage return. Of course, we want some open interest. This isn't your strategy. This is an exact question I had yesterday, a customer that called in at 10:25 in the morning saying, I want to create a search in naked puts for ETFs, higher yield ETFs. I only want to go 20 to 40 days out, not necessarily to the next expiration. And I want to avoid leveraged ETFs, but this is a real one. How do I do it? Okay, let's talk about how you do it. So the exact conversation and the exact things I walk the customer through is we went ahead, logged on to Power Options. We went to Naked Put. Yes, there's things here we can click for the picks of the day, monthly and weekly. I'll talk about that a little bit later. And we went right into the search tool. And what do I see here? Well, Mike's Weekly Naked Puts doesn't have any results at this time. That's okay. It might be too restrictive. Really, it's because we're only 3 days to expiration, so I shouldn't expect the kind of returns I'm looking for with the probability and range out of the money I want to see for this particular search. However, I can quickly toggle between our default settings. And every strategy, we put together 3 or 4 default settings. You'll notice by the double asterisks here when you click the drop-down menu in the Search Settings Saved As field. These are the criteria that Ernie and I would start off with if we were opening our own trade. The weekly picks of the day, I want to trade weekly naked puts, this is where I'd start. I want to trade weekly bull puts, I'll go to Bull Put Credit, click on Search, click that drop-down menu, and select weekly bull puts. If you prefer monthly, now here's the criteria we put together and tested over time to create the picks of the day, the best return we could see with constant criteria over 1 or 2 year period, and of course deep out of the money puts as well. These other ones are all searches I've saved. But for our customer, what were the first steps? We logged on, we went to the search. We ignored the results that came up on the top. Let's just go to monthly picks of the day. There we go. So we ignored all the trades that came up, scrolled down to the bottom of the page where our filters are, the parameter field, our options, technicals, fundamentals, and lists. Now the first thing we do, clear the filters. Going to empty everything out. It doesn't erase the search, just empties everything out for us. What were our requirements? Well, we knew the time frame, the return, basic open interest, and that he just wanted to see ETFs and non-leverage. So the first thing I need to start off with is let's go to lists. I'm going to click on the list drop down here for the stock lists. You can also do sector and industry. You can include or exclude. We're going to tell the system we just want to include indexes and ETFs. You see some of the other lists we have here, NASDAQ 100. I had a gentleman last week, wanted to do bull put credit spreads just on stocks in the NASDAQ 100 that were trading above their 20-day moving average and offered an 8% return. 7 clicks, his search was created. So here, we're going to go to indexes and ETFs. What else? We wanted to avoid leveraged ETFs. The more volatile 2X, 3X, and Ultra ETFs, no problem. I'm going to click Exclude. Go down the list in alphabetical order. We're going to remove leveraged ETFs. I can also choose to remove the inverse ETFs. Now, the customer didn't mention that he wanted anything as far as fundamentals. But if I wanted to see ETFs in a certain price range for the naked put, if I didn't want to go above $200 or $300, we could just put that in. I'm going to leave it blank for now. But with covered calls, cash secured naked puts, long collars, married puts, you're going to want to restrict the stock price based on your account size and what you can afford. Normally in a naked put screen, I would also avoid earnings between now and expiration. That doesn't relate here because we're looking just at ETFs. They can be moved by stocks that have earnings inside the ETF, but we don't have to worry about a large 10, 15, 20% swing one direction or the other with what we're looking for. And then for the technicals, I would likely look for a stock trading above the 20-day moving average in this case, a bullish strategy. So I'd select stock price above SMA 20. That wasn't one of the requirements, so we didn't do that. I may look for ETFs with a good average stock volume, a good average volume. This is measured in thousands, so I might look for at least 500,000 shares on average per day. I do that with covered calls, with naked puts, bullish strategy. I want to see good volume. That wasn't one of the requirements, though. But those are three things: earnings, simple moving average, and the average stock volume that I'd put in as a starting point, looking across the broad universe of options for covered calls, naked puts, even bull put spreads, bull call debit spreads, probably calendars and long callers, neutral to bullish positions. Okay, but let's move on. Now to the options. What did we know? The investor wanted high return on these ETFs 20 to 40 days out. So I can just go to November, but that doesn't really match. So we're going to stick with all expirations. I'm going to limit it by the days to expiration. We're only going to go 20 to 40 days out in time. It's going to filter out the November, but we are going to see any weeklies that match that criteria that may be 2 weeks out, 3 weeks out, or more. Now the time value's return was about 3%. That sort of implies a 3% time value. I could put that in, but I'm actually going to put that here in the naked yield, in the returns field. So at least a 3% naked yield, and we wanted 8% protection. Now I could do 8% out of the money. We could use the percent to break even. This is a little bit more common. In covered calls, we call it the downside protection, how far the stock can drop before we're technically losing money on the position. We're going to put 8% there. Now I don't need to worry about probability. That's kind of already taken care of with our percent to break even. Probably looking at naked puts, even with a 3% yield, on these more volatile ETFs that are probably in the 75 to 80% or higher probability above. And then of course we wanted some liquidity, open interest or volume. I'm not going to worry about volume today. We're going to look at the open interest. And let's say on average, you like to trade 5 contracts of a spread, cash secured naked put. Well, I might look for something at least 5 times or 10 times the open interest. Let's just start with 25. All right, that's it. Over here, it shows me exactly what my actions are, the active filters for the naked put screen. Okay, so I put in my time frame, my yield, break even, didn't put any technicals, no fundamentals, just screening against indexes and ETFs and excluding leveraged ETFs. So 1, 2, 3, 4, 5, 6, roughly 7 criteria. 8 or 9 clicks, 10 or 11 if you include clearing the filters, and now we click Submit Search. So out of all ETFs and indexes available, all of the various strikes, all of the weekly options series for all of those ETFs that exist, with just some basic criteria that match the needs and the customer's trading plan, we've narrowed the entire universe of options down to only 23 total results. These are the results that match his criteria. This is exactly what this customer was looking for. And now, once he's created this search, he can simply save the search, and every time he comes into naked put and search, doesn't have to go through it again. The exact trades that match his trading plan and his goals will appear, and then he could do his further research and analysis. This is a time saver. You don't have to go to your broker, look up what ETFs match certain volatility and certain other criteria, then go to the option chain and say, okay, which one of these strikes 1 week out, 2 weeks out, or 3 weeks out offers me the 3% yield I want with the 8% out of the money range or 8% to break even. You've done all of that here on one screen, and you have 20 results that match your criteria. And if you wanted to avoid the volatility indexes, VXX, SVXY, no problem. Just skip to the ones that match. You've got the EWZ, XLK, I'm sorry, I almost said KLX, the XLK technology sector. Yesterday we also had oil in here, as well as one of the biotech ETFs. Now I'm not saying that this is the best way to trade naked puts. I'm not saying this is the best way to trade naked puts on an ETF. This new customer wanted a faster way, a time saver, to find a very specific screen. And we were able to do that with just 7 or 8 clicks. Search for him the exact 23 positions that would match his criteria for his specific goals as well. Ron made a comment, missed the first half. Is this recorded for viewing? Absolutely, Ron. It's going to be posted later this afternoon. I'm going to send everyone an email when this is available. Okay, so that's just for naked puts. What did we see? We see the same criteria that we reviewed, very similar to the screenshot I showed you for the covered call position, but some things are subtly different. We look for a % naked yield and a % to break even instead of a % return and a % downside protection. But the implied volatilities, time frame, price and strike price ratios, bid-ask spread limitations, probability, liquidity is all there. The technical screens, the fundamentals, all the same in all 23 different strategies, and of course you can create your own personal lists. Some other ideas, bull put credit, for example. How is that going to look? Well, let's go to bull put. Remember, we go into the search. Yes, we have default criteria set up for you, which you can use as the stepping stone to create your own personal search, or you can go in, clear the filters, and put in what you want to see specifically. Differences here, implied volatility ratio between the sell and the buy, minimum net credit requirement, % return, instead of % if assigned a % naked yield, but still the return, and the maximum risk. Limitation, monetary limitation, I should say, so you can control the difference in strike prices. Range out of the money, very similar. Probability, deltas, delta ratio, and more, bid-ask spread limitation, and of course strike difference. So I can set this manually myself. Liquidity, same as the other 23 strategies, same technicals, same fundamentals. So in any strategy, you can narrow it down specifically to what you want to see. And sometimes when you get into combinations, diagonals, calendar calls, iron condors, you see a little bit more criteria as far as the ratio. So now with a calendar, of course, I'm sorry folks, with a calendar, I have to select 2 expiration time frames. If you like doing calendar spreads where you're buying an option that's 3 months, or I should say 3 weeks out in time, and you're selling weekly against it, it's very easy. I'll just set this to be 15 to, let's say, 25, 2 to 3 weeks out, and I'll set my near-term expiration to be 0 to 5 days. So now I'm looking at calendars where I'm buying 3 weeks out, selling near-term against it. But if you like the poor man's covered call idea, buying a deep in the money leap option, of course you can screen by just the expiration you want, standard expiration. We can go to leaps. We can just look at all leaps as well. I'm sorry, up at the top here, I could choose just to go all leaps for my long and then what time frame I want to sell against it. But now, of course, we've got to focus on the time value for the short and the long. Implied volatility for the short and the long. Implied volatility range for the short and long. It gets a little complicated, but it still is everything you need. I mentioned the delta ratio, long option delta, short option delta. Range in the money or out of the money for the short and the long. And you'd see these kind of combination criteria, this increase in criteria because of combinations of using a long and a short. You'll see that in iron condors and iron butterflies as well when you're doing multi-legged strategies. All right. Now, let's talk about that. So we just reviewed what we looked at with the customer that called in. I should have told you to count with me. But that screen with that 4 criteria to narrow the entire universe of potential naked puts on ETFs down to only 23 results was only 12 clicks, 7 key entries, and once it was done, it was saved, and the customer can go in at any time he wants to open a new trade, go to naked put, go to search. The system will remember which last saved search you're reviewing, so right in front of you are only the trades that match your trading plan. Okay? Skipped ahead there. Went a slide ahead. I should have done that before we clicked over, but there's only 12 clicks to create that search, including clearing the filters, including clicking naked put and going to search, clear filters, and then 1 submit. So 4 clicks right there out of the 12. The other 8 were just to select the list, remove the inverse, put in the return, the time frame. It's only 4 or 5 criteria, but it narrowed the universe down. And you might say, well, I don't know what to look for. Well, you already know what you don't know, believe it or not. I know looking at the criteria can be overwhelming. You look at all these greater than or less than columns with all these options terms and standard technical and fundamental terms as well. It can be very overwhelming. But I bet you that whatever strategy you're interested in trading, you already have 5 or 6 criteria that you want to see that are most important to you. And just like we just showed, start with those 5 or 6, enter your criteria, and run the search. If you have over 100 results, tweak a little bit more. You go into the search for bull puts. You want to look 1 week out in time. You want to look for next Friday's expiration, about 10 days out, so you put in your time frame. You want at least a 15% leveraged return. You want a probability of 70% or higher. You want a minimum net credit of 20 cents. And you want stocks trading above the 20-day moving average. You put in those 4 criteria, and you have over 100 results. How can we narrow that further to be a time saver? Well, if you were happy with spreads that at least had a 70% probability, you were going to be just as happy with spreads that have the same net credit and return that have greater than an 80% probability. Bump that up. Narrow down the results. If you're happy with a 15-cent net credit with a 75 or 80% probability, you're going to be happier seeing the ones with just a 20-cent net credit. Up the net credit, up the probability, you're going to slice that by more than half, I guarantee it. Now, you run a specific search. Let's say you want covered calls, stocks in an uptrend, good earnings per share growth, 3% dividend payment, looking to sell an out-of-the-money call at least 30 days out in time or less, let's say next available expiration month, November, 45 days out, and you want at least a 5% downside protection and a 5% return if assigned. Well, dividend-paying stocks that have good quality to them and pay a higher dividend of 3 to 4% aren't offering a 5% time value even for 45 days out in time. You might only have 1 or 2 results. You might want to open that up a little bit more. Lower the requirement for downside protection or percent return. Lower the requirement for dividend, maybe from 3% down to 2% or more to see what comes up. Open that up. Now, as you saw, when I first went to the bull put screen, it was one of my saved searches that we used in a webinar. Sometimes you might put in 5 or 6 criteria and get no results. That means something was clashing. I knew right away when I saw no results and we had that Mike's Weekly naked puts default search come up, or my saved search I should say come up, I knew immediately what the problem was. It's looking specifically for weeklies that are 5 to 7 days out in time. I believe it's 8 days out in time with I think a minimum 0.5% naked yield and a minimum 25 or 30 cent premium with being 5% out of the money. I know what's clashing. There's no expiration between now and 8 days unless I'm looking at the Monday or Wednesday expiration on the ETFs and SPX that are available, okay? The options that are 3 days out in time won't match my requirements. That expire on Friday, they're not going to match my requirements. Okay, I'd have to lower that percent naked yield or lower the range out of the money or lower the premium in order to see positions that expire. But I have to be realistic. You might have something that's clashing if you see no results. Should you expect a 20% return with a 90% probability on a credit spread that's expiring in 2 to 3 days? No. Should you expect a 50% return or 50% downside protection on a leap or 1 year out at the money covered call? buying a stock at 20 and selling the 20 call for 400 days out in time to get a $10 premium. No, you shouldn't expect that. Should you expect to find a no-risk collar, meaning I sell a call and buy a put that has no risk, a no-risk collar, but still offers a 5% return if assigned if the stock moves up 1%? No, that's not how the structure works. But if they are there, if those trades do exist, the search tool will find them. It'll find you those opportunities. Dare I say the unicorn opportunities that might come up. This tool can help you find it with, as we saw, just a few clicks of the mouse, just a quick search. You see if anything's there, and if no results are there, something is clashing. Now, remember, keep it simple. You can always use our default settings as a stepping stone. When I open the bull put credit search, I go right to the default weekly bull puts. When I'm opening a bull put credit spread, I'm usually selecting the top 1 or 2 trades from that list for my personal portfolio. Okay? We have tested most of these. We put the criteria together based on what we would use and what we have seen works historically through backtesting tools that we use and other tools, so that it's reasonable, number one, but number two, over time, it's also profitable. That's where we would start to identify positions, whether it's weekly or monthly, whether it's income. In the long call, if I'm looking for long calls, I'll use Ernie's default search in the long call screen for Bollinger Bands, looking for stocks near the upper band, potentially showing a breakout. Okay, and I'll do my further research and analysis on those positions, but that's my starting point. Okay, and then as I mentioned, we show those weekly and monthly picks of the day that Ernie exhaustively tested over extended period of time for covered calls and for naked puts. And the weekly search in the bull put screen, I tested extensively as well. It's not quite a pick of the day, but that's what I use, and that's what I recommend to our customers to use as a starting point, but then you change the criteria based on your needs. Okay? You want a little bit more protection, that's fine. Take the default search and increase the probability or the range out of the money. You want more premium, that's fine. Maybe lower the probability and increase the net premium and the net return to match your trading plan. But you can use it as a starting point, but we also show today how easy it is to just go in, take your important criteria, clear out the filters, put in what's important to you, and run that search. If you have too many results, increase. If you have too few results, open it up a little. Now, the first time I've ever done this, I don't know how it's going to go, but when you logged on to the webinar, you probably saw something. I don't think I can do a screenshot of this, but in that panel, the GoToMeeting, GoToWebinar panel that appeared on your screen, you saw something called Handouts, and there was 2 handouts there: Guide for Setting Criteria and Power Options, and Criteria, List, and Rating. Okay? So if you're still not sure of what to do, well, pull up these. You can click right on them in that view there. Okay, so let me see what happens if I click it. So I'm going to click Guide to Setting Criteria. It's going to open up in, I don't know why it's opening here. It's opening up in Internet Explorer. So the Guide for Setting Criteria, just clicked on it. Hold on, folks, I'm sorry. Like I said, this is new. I don't know if you guys can see them directly or if I click on it, it sends it to you directly. But in these handouts, oh, no, didn't do that. It did open it. It's just a simple Word document. But here's the Guide for Setting Criteria. If you feel that you're overwhelmed every time you pull up the search and you see all those things, stop. Download this file. Click on it in that handouts box. Print it out and write down what strategy are you searching for. Just write in bull put credits, bear call credits, whatever you want. What time frame are you looking for? Okay, so let's do it. Bull puts. Okay. What time frame? Not weekly, but let's say under 15 days. All right, so weekly or anything under 15 days. What is the minimum premium you'd want for your bull put? You know that. You know that based on the number of contracts you trade and what your commissions, what makes sense to you for a 15-day trade. Is it 35 cents? 25 cents? You know what that is. Well, in this case, I said, are you looking out of the money, in the money, or at the money? Well, of course, we're looking out of the money. I know I'm looking OTM. I might use probability. I'm probably going to be going at least 75% probability or higher. Okay? What probability are you looking for? I'm sorry, that's the next one. That'd be 75%. Using out-of-the-money covered calls, you'd be looking for a lower percent if you don't want to be assigned, okay? Liquidity do you prefer? Maybe 5 volume minimum, 100 open interest. Just jot it down. Okay, now fundamentals, is this bullish or bearish? Bull put credit spread. Neutral to bullish, it's in the name. Oh, let's say bullish, okay? Should you avoid earnings? Absolutely. I don't want any earnings around when I'm doing a credit spread of any kind or a debit spread. Do I want to avoid small cap stocks? Well, that's up to you. I can leave this blank and just ignore it for now. Should I follow the trend? Probably. I might want to look for stocks that are trading in an uptrend, had a positive MACD crossover. That's what I want to look for. Do you want good underlying stock volume? Perhaps. I'll leave that one blank. And do you use Bollinger Bands, MACD or RSI, all available in the technicals we showed. I use MACD, so I'm actually going to use that as a setting as well. Okay, so right here, basic use of a strategy. What I'm looking for personally, what do I have in this little handout here? I've got 1, 2, 3. Okay, that's cheat. There's 3 there. This is kind of 4, 5. We didn't use the market cap there. Okay, we're not going to avoid that. And now I've got, I hate how it scrolls with me, but I've got 6, 7. Only 7 criteria of about the 85 I could possibly use in any strategy. And I think that is enough for me to get started to create a basic search in the bull puts. My time frame under 15 days. Minimum net credit 35 cents. Probability 75 or higher. Liquidity 5 and 100. Well, it's bullish, so I might look for something with a positive earnings per share growth, but I'm definitely going to avoid earnings between now and expiration, and I'm probably going to look for stocks above the 20-day moving average and a MACD crossover within the last 3 days to show a breakout for my bullish strategy. 1, 2, 3, 4, 5, 6, 7, possibly 8 if I put in the earnings per share growth. That alone is enough, and these are just basic criteria one would use for a bullish strategy or a strategy that makes sense. Okay, so start with that. You're not sure what to use? Click on that handout there, Guide for Setting Criteria and Power Options, regardless of strategy. Then, once you're done with that, open the second one, Criteria List and Rating. Okay, it's going to open up in a browser window, and then it's going to take you to a PDF document we uploaded here. And now I'm going to rank what's most important to me. Is it return? Is it probability? Is it the fundamentals? What were our results here? Sorry, 38% of you said the risk. Okay, so in that case, it'd be probability. But then probably followed by the return, maybe the strike difference. That's also a preference I didn't include in that sheet. That's separate for you, separate for you credit spread traders, right? If you only want to do 5-point spreads or 10-point spreads or less than 3-point spreads, you can set that. Okay, so our strike difference there. Minimum net credit, different than the return, but yeah, that's still important to me. Let's see. Open interest, probably not. Avoid earnings. That's very important to me in the 7 or 8 criteria that I clicked in. Number 6, of course, MACD. Yeah, sorry, MACD. Got that. Oh, liquidity now for the options. Okay, so why is this sheet important? Why am I showing you this sheet as well, and why am I going through this? Because when you hit clear filters, I put in my probability first, my return, strike difference, net credit, check the earnings, MACD. At this point, I might just run the search. And I've got my other 2 or 3 criteria down here if I used earnings per share growth or more. But after 5 or 6, I might just run the search. And if I've already narrowed it down to 20 results, if I keep going, I might go to 0. So that's a good starting point. Just put in a few at a time. You already know what you want to see. And then, of course, down here below, once you've filled that in, create your search. Start with the first 5 or 6 filters and run it. Sort your results. You can change the sort in any of the search by any strategies by any criteria you can enter. So sort it by, I'm going to sort it by probability, highest to lowest. I want the highest probability up top, the best safety. 38% of you were focusing on the at-risk risk-reward ratio. Probability is referring to the risk, not the monetary risk, but the risk of success, possibility of success, lower risk of losing. So I'd start there. Or I could sort by return, which is a risk-reward ratio looking at the net credit divided by the margin requirement in this credit spread. So I could do either or, highest return, highest probability. That's up to you. But write it out first if you're still overwhelmed, and then just put in what meets your criteria. And again, too many results, increase the return, increase the probability, increase the net credit, filter those down. If I was happy with 35-cent net credit and what did I say? Of course, 15 days out in time, that would probably be number 3 or 4 would be the time frame. Forgot to put that in my list, but that's okay. But again, if I'm happy with 35 cents, 75% probability and a 5% return, I'm going to be happy if there's 45 cents net credit, 80% probability, and 7% return, aren't I? Those would be the higher trades with the best probability and the best return, so I can increase that. Again, too few results, lower some of those criteria. Maybe the premium, maybe lower the probability a little bit, maybe lower the return, or maybe even the volume or open interest. And no results, well, something's clashing. I see this often, and it's okay, because again, I think it can be overwhelming. These two sheets will kind of help you. An investor is telling me that he wants to look for out-of-the-money covered call opportunities on dividend-paying stocks because he's hoping not to get assigned and increase his dividend income weekly or monthly by selling out-of-the-money covered calls. Good strategy, great idea. But he wants a probability of being assigned of 80%. Well, that doesn't make any sense. An out-of-the-money covered call, by definition, is only going to have a probability of 25 or 35%, or a delta of 0.25 or 0.35, not 0.8. Not an 80% probability assigned. That's an in-the-money, right? You're clashing. Okay? I mentioned earlier, we talked about maybe looking, is there an at-the-money covered call that's 1 year out in time that's going to offer me a 50% downside protection? I buy a stock at 20, sell the 20 strike call 400 days out in time and get $10. No. Okay? Return expectation is too high. I mentioned earlier too, we showed that little discussion there. Should I expect to see a 20 or 25% return on a credit spread with a 90% probability on Friday morning for that day's expiration? No. The return's going to be maybe 5%, maybe 4%. It's going to be 4 or 5 cents on a 1-point spread perhaps. 8 or 9 cents on a 2-point spread, something along those lines. I'm not going to get 20% for a one-day trade with a 90% probability. If it's there, the tool will find it. But if you get no results, it's because something is clashing. Something is too high, okay, for your expectations. And of course, if you get stuck, this is just on the screenshot here, but if you get stuck, you send me an email. You give me a call. Trial members and subscribers, you can always schedule a coaching session, okay? All right, so get those handouts. Guide for setting criteria and power options. Use that as your starting point, and then the criteria list and rating. Once you fill that out, go to the search. Follow what's on the sheet. Don't get intimidated by all the greater than and less than fields that you see and the 80 or so criteria you can use for technicals, fundamentals, lists, and options. Put in what you want. Or again, use our defaults as your stepping stone. Other pointers, well, always consider the strategy. You've heard, we've talked about it already, but let's review it. Neutral to bullish, covered calls, naked puts, bull spreads, bull put credit, bull call debit, diagonal calendar call spreads, married puts, collars. I use the same fundamental and technical criteria for each of those strategies pretty much because I want the same thing to happen. I want stocks that are staying the same or moving up in price. I want quality stocks that don't bounce around all over the place. So I'm going to look for stocks that reflect good management, a good earnings per share growth, okay, and the fundamentals there, maybe at least 5% or more, a relative PE ratio, 0 to 50, 0 to 70. I'm going to avoid earnings in these neutral to bullish income strategies. I may just look for mid to large cap stocks as well. Okay, and for the technicals, yeah, I might want good volumes, stocks in an uptrend, using the MACD or the Bollinger Bands, or simply just a stock above the SMA 20 or the SMA 50. Okay, so bullish to neutral strategy, that's what I'm going to do. Neutral to bearish, hey, we can just kind of reverse it. Bear call credit spreads, bear put debits, covered puts, naked calls, calendar put spreads. I might look for a negative earnings per share growth, percent EPSG of less than 0. Stock in a downtrend. Stocks below the SMA 20 SMA 50. Maybe you, again, prefer to use stock SMA value where the stock, the 50 days below the 100 or the 50 days above the 100. That's very common to use. Okay, that's something I would put in. Or the MACD, something that just showed a negative MACD crossover in the last 4 or 5 days. Still, avoid earnings. Don't want that surprise and have it go bullish on me. Okay, other pointers, long-term bull, things for long calls. Married put, a little bit more bullish married put, and even calendar calls if I'm buying that in the money leap far out in time and trying to sell monthly or weekly against it. But specifically for long calls and maybe a straddle, I'm going to look for higher earnings per share growth. You know, if I'm in a married put or a diagonal call spread, and I'm thinking, well, my expectation is over the next year the stock's going to grow 10%. Well, I'm going to want to see an earnings per share growth of at least 15 or 20%, a driving force of good management and positive earnings that would help that stock move up 10%. I shouldn't expect the stock to grow 10% if it has negative earnings and has had bad quarters recently. Sure, it could reverse. Why take the chance? Look for better opportunity. Relative PE as well. Good volume, stock in an uptrend. Positive MACD cross over a several-day time period. You saw that you could use those historical trends for the number of days the stock's been above the 20 or 50. If I want a more pronounced uptrend, I might look for stocks that have been trading above their 20-day moving average for at least 8 or 10 days. The MACD crossover, the MACD has been above the signal line, but the MACD has crossed over the EMA for at least 10 days or more. And long-term bear, of course, I'll reverse it. Negative earnings, downtrend, maybe a Bollinger Band breakout to the bottom. For neutral only, short straddles, short strangles, not buying. Selling a call and selling a put in a straddle, selling a call or selling a put in a strangle, iron condor or iron butterfly. It's a little tougher, but I can use the Bollinger Band ranges, the percent BB20, where's the stock now in relation to that upper or lower band. I'm going to push it right into the middle. Percent BB20 of only 40 to 60. And I'm going to look for lower bandwidth. And that's where the Bollinger Bands, more volatile stocks can have a very wide Bollinger Band. As I mentioned, things that are condensing, things that are in a trading range are going to have a shallower or closer, a tighter Bollinger Band range. So I'm going to look for lower bandwidth, maybe less than 20%, maybe less than 30%. I'm going to look for lower historical volatility. And some of you might say, well, if I'm selling premium, a straddle, strangler, and iron condor, don't I want higher volatility? You might want to look for higher implied volatility, but you don't want a stock that's bouncing around, even with an 85% probability between in a short strangle or an iron condor. You want something that's consistent. You want something that's staying within a range, which usually implies lower volatility. I don't want to be bouncing all around and trying to catch where my limits are to sell the short call and the short put with that strangle or with that iron condor. And as always, avoid the earnings and avoid the events. Regardless of your strategy, regardless of what you're trading, we've got 25% of our audience doing covered calls and naked puts. 19%, I believe it was, doing protected positions, collars, and married puts. 44% doing credit and debit spreads. And 6% buying calls and puts, 6% doing diagonals. Regardless of your strategy, this is the most flexible tool I've seen for a self-directed options investor. I do have brokerage accounts. I don't use any of the tools on my brokerage account. I'll log on to my brokerage account to make a trade or adjust a trade. I've done everything on Power Options. I know exactly what I'm seeing. I know exactly what the stock is doing, what the technicals, fundamentals, and the options criteria were. I log onto my broker to place a trade, and that is it. It is a time saver. Any of my saved searches I open, at that moment, I'm only looking at probably the top 20 or 25 trades in my criteria. I've narrowed the universe down to a limited list. My trades are coming from that results, those results that match my criteria. And again, just as I do with the bull put spreads and the married puts for the radioactive trades that I post in Fusion for radioactive subscribers over there that follow Ernie and my married put trades with radioactive trading techniques, you can get started with our defaults. I pull my trades directly from the married put default screen for the Fusion subscription, and the bull puts I trade, I take right from that bull put weekly, the top 1 or 2 when I'm opening a new trade. And you can also see exactly what we're using, that active filters bar over to the right. You're seeing exactly what criteria we're using for those searches, so you know exactly why they're coming up. But again, we also showed today how easy it is just to clear the filters, take your 5 or 6 from those 2 forms I gave you, the guide for setting criteria and the criteria list and rating, put those in, run your search and your strategy. I guarantee you with just 5 or 6 criteria, you've probably narrowed the universe down to less than 50 trades, 50 possibilities, and you know those match your goals specifically. And you can choose to be as restrictive or as open as you want. Actually a month ago, I had a gentleman call up. He was a new trial to Power Options. He's doing covered calls. He's a very limited account. And he said, I only want to see covered calls. I'm going to only put $800 into a trade, so I only want to see covered calls on stocks between $2 and $6 with a 2% return. Can't have earnings. We just put in those 3 criteria, and he had 8 results. That's a time saver. That's narrowing down the universe of options for him. He knew exactly what he was getting into, exactly what he was looking at with only 3 criteria. I consider that extremely restrictive. But again, it matched that customer's needs, goals, and trading plan, and that's the power of the search tool. A time saver, you know exactly what's there, you know exactly why the trades came up, and you know if you've created your own search, it matches your specific criteria for your trading plan. And of course, you can further research and analysis. You can do further research and analysis on those trades. We'll go over that next week, next Wednesday at 12 noon. We're going to talk about using the Power Options tools after this point to further research and analyze these positions. But how can you get started? How can you get started with this time-saving search tool? It supports 23 different of the commonly used option strategies that are available. We'll just take a trial. Go to powerop.com. No credit card is needed. We can't automatically bill you or anything like that. Just put in your name and email address. You'll have full access to the Power Options tools for 14 days. You'll have access to all of our default searches in those strategies, plus the picks of the day for the covered calls, naked puts, and of course, you have access to all of our help tutorials, videos, and even ourselves. Send us an email, give us a call. Remember, anytime you get stuck, follow the tutorials. There's a little button called Help Videos on the search tool that gives you some guidance. Click on those, check those out. You want specifics maybe on how to set up a search for a calendar spread. Go to our webinars page, the free webinars link under the Home tab on your account, or just go to powerop.com/webinars.asp. It's a public page. Click on Option Strategies, and you'll see full webinars there on criteria for credit spreads, debit spreads, calendar spreads, covered calls, naked puts. We walk through by strategy for the search tool as well. So you want to check those out if you need a little extra help. But again, call me anytime. We're here during market hours. You can reach us at 302-992-7971. Send me an email at any time to support@powerop.com. And those of you that are currently on a trial or a subscriber as well, schedule the coaching session at any time, okay? And just go ahead and schedule a coaching session. That's essentially a 35 to 45-minute phone conversation with myself or Ernie, walk you through the tools on the site and answer any questions that you have. All right, well, ladies and gentlemen, I hope those handout links worked for you. I hope you got some useful information out of today's webinar on using the Power Options search tool, what's available for you, and how powerful it can be to help you save time finding new trades, getting exactly what you want to match your trading plan, and more. Again, if you have any questions at any time, send me an email or give me a call. I hope to see you next week for a follow-up webinar on researching and analyzing a position using the Power Options tools. Of course, I can talk to you at any time during the week going forward. We'll also be back, as always, Friday at 4:30 p.m. Eastern Time for our Power Options Open Forum Q&A session. If you have any questions regarding that as well, if you have any just basic options questions, we host an open forum. I don't have any planned material Friday at 4:30. What you can do is just log on, send me your questions, even on your trades, and we'll just answer those questions on the fly. Ron asked a question. My apologies, Ron. Let me just go here. Here we are. All right, so Ron asked, after the trial, what is the cost? Well, our subscription monthly service cost, we have subscription levels that start at the $40 level per month, and that's for the end of day data. So it's only updated at the end of the day, but that lower subscription also with the end of day data does not include the picks of the day we talked about or getting your search results by email. You can also request to have any of the default searches in a strategy or the ones you created sent to you via email at any time during the day. Those two features are not available at the end of day service, but does start at $40 a month. $60 per month gives you access to all the tools, the picks of the day, search results by email with 20-minute delayed data. Okay, so every time you run a search, you're seeing positions that are made 15 to 20 minutes delayed. We have offer a historical service for back testing. You can do a historical search based on your criteria to see how it would have performed month by month. That's $100. And of course, we do offer a real-time service. So every time you run a search, refresh the page, you're getting the numbers and calculations at that very instant. And that's $120 per month. The premium service is the real-time plus the history, and it includes access to the API, the programmer's interface as well. But those are the subscription levels available for Power Options, Ron, starting at $40 per month for access to the searches, creating your own searches, still with the coaching sessions, the emails. You just don't see the picks of the day report. You can't get your search results by email. But if you're doing spreads, if you're doing weekly options, you should be at least at the $60 per month with the delayed data. Okay, the end-of-day data sometimes isn't enough to do the weekly positions, even if you're just doing weekly covered calls or naked puts. You want to be on that delayed service. Okay. All right. Well, ladies and gentlemen, I think we've covered everything I wanted to cover today. Thank you for joining me. Again, I hope this was a useful presentation to you, and I hope to see you at one of our upcoming webinars in the next few days. Have a great trading afternoon, ladies and gentlemen. Take care. Good night.